Hello, everyone, and welcome to Financial Accounting. Today, we're going to continue talking about inventory and we'll discuss lower cost or market and other inventory write-downs. Before reporting the value for inventory on the balance sheet, companies consider any needed reductions for obsolescence. We already looked at inventory write-offs in the inventory valuation video. If you haven't had a chance to watch it, the link is in the upper right corner and in the description to this video. Companies take a physical count of inventory at least once a year and write off all losses due to spoilage, breakage, damage, obsolescence, and theft. The physical count helps get records up to date to reflect what is actually on hand. If a physical count identifies inventory shrinkage, an entry is made to debit cost of goods sold and credit inventory. This entry increases cost of goods sold and expense account and decreases the inventory account. In addition to shrinkage losses, the value of inventory may decline because the merchandise has become obsolete or is unable to be sold for other reasons. If inventory has become obsolete or is otherwise unsellable, its carrying amount in the accounting records should be written down to zero or to its scrap value, if any. A write-down of inventory reduces both the carrying amount of the inventory in the balance sheet and the net income of the current period. The net income is reduced because the cost of goods sold or losses from write-down of inventory accounts are debited or increased to offset the credit to inventory. We will look at a sample general journal entry on the next slide. The reduction in income is handled in the same manner as a shrinkage loss. If the write-down is relatively small, the loss is charged or debited directly to the cost of goods sold account. If the write-down is material in amount, it is charged to a special loss account called loss from write-down of inventory. This account has the same rules as any expense account. It is increased by debit and decreased by credit. It is reported in the other income or loss section on the income statement. Let's look at the general journal entry. We debit a loss from write-down of inventory and credit inventory. In addition to recording write-offs due to obsolescence, companies also make sure to adjust the inventory value to the lower cost or market. Cost is determined using one of the methods we already discussed: specific identification, FIFO, LIFO, or average cost. Market is defined as the current replacement price of the inventory. Reporting inventory at the lower cost or market follows the conservatism principle by not overstating the value of assets. The lower of cost or market rule can be used in conjunction with any cost assumption. We can apply the lower cost or market rule to individual inventory items, the categories of inventory items, or to the total inventory. Let's look at the example. Assume that Joel's ski shop uses the FIFO cost flow assumption. The store sells various lines of merchandise with costs and market values shown on the screen. Measured at its FIFO cost, the inventory of Joel's ski shop is currently recorded at $29,000 in the general ledger. Let's apply the lower of cost or market rule on the basis of individual items first. Look at each item and compare the item cost with the market value. As the name of the rule implies, we select the lower amount for each item. For the first line, for example, we select cost of $16,000 because it is lower than the market value for this item. Compare the cost with the market value for each item and select the lower number for each item. Then add all selected numbers. The total is $26,500. The inventory would be written down to $26,500. This is accomplished by reducing or crediting the merchandise inventory account for $2,500, which is $29,000 less $26,500. If we apply the lower of cost or market rule on the basis of inventory category, that is ski equipment and ski accessories, we will write down the $29,000 FIFO cost by $1,500, which is $29,000 less $27,500. Similarly to previous example, we compare the cost with the market value of each category and select the lower number for each category. The cost of ski equipment is $20,000, which is lower than the market value of $21,000. Therefore, we select the cost of $20,000. The cost of ski accessories are higher than the market value. Therefore, we select the market value of $7,500. $20,000 for the first category plus $7,500 for the second category is $27,500. Likewise, if the lower of cost or market rule is applied on the basis of total inventory, a write-down of only $500 is required, $29,000 less $28,500. The market value of the total inventory is selected because it is lower than the cost. In the financial statements, most companies state that inventory is valued at the lower cost or market. In an inflationary economy, however, the lower of these two amounts is usually cost, especially for companies using LIFO. Another approach is called lower of cost or net realizable value. If inventory declines in value below its original cost for whatever reason, a company should write down the inventory to reflect this loss. The general rule is to abandon the historical cost principle when the future utility or revenue producing ability of the asset drops below its original cost. In this situation, companies write down inventory to net realizable value to record this loss. Net realizable value is the net amount that a company expects to realize from the sale of inventory. It is an estimated selling price in the ordinary course of business, less reasonably predictable costs of completion, disposal, and transportation. Let's look at the example. Mender Corporation has unfinished inventory with a cost of $950, a sales value of $1,000, estimated cost of completion of $50, and estimated selling costs of $200. Mender's net realizable value is computed by subtracting estimated cost of completion of $50 and estimated cost to sell inventory of $200 from the inventory sales value of $1,000. Net realizable value is $750. Mender reports inventory at $750. In its income statement, Mender reports a loss due to decline of inventory to net realizable value of $200, $950 less $750. Same as with lower cost or market, lower of cost or net realizable value rule can be applied at the individual item, category, or total inventory levels. Let's look at the general journal entries to record write-downs of inventory. In both cases, inventory is reduced or credited. If the amount is immaterial, the debit is to the cost of goods sold account. If the amount is material, the account called loss due to decline in inventory value is debited. Note that losses are recorded in the other revenue or expenses section of the income statement. Thank you for watching this video. I hope you found it helpful. Feel free to share it with anyone who is interested in learning accounting. I will see you next week.